first thing I would say is to take a good hard look at the tax function and consider putting a ring fence around it in terms of headcount. And really challenging that knee-jerk reaction to mandate headcount reductions in tax, much like CFOs might be doing in the broader finance organization or enterprise-wide. The reason being, again, that tax departments are rather significantly understaffed in many cases. Unfilled requisitions are very predominant out there today. And the right skill set is often missing from tax in certain key areas like tax accounting or managing foreign tax matters or managing controversy issues. So there's some key competencies that are missing from the headcount list. So I would encourage CFOs not to take that perhaps knee-jerk reaction and look for headcount reductions in tax, but to think through what might be beneficial in terms of managing risk. And you may come up with a very different answer. And the second area that I might suggest for CFOs is again, if you feel like you need to manage headcount downward in tax, perhaps allocating a larger part of the IT budget in favor of the tax function to help minimize the impact of reduced headcount through efficiencies that are gained through technology enhancements. The challenges, I think, stem from originally the Sarbanes legislation. That was a major paradigm shift for tax departments. Of course, Sarbanes-Oxley being an audit of controls, which you can liken to processes. And processes really are not within the primary skill set of most tax professionals. So in 2002, enter the Sarbanes-Oxley legislation. You've got tax organizations that are staffed by highly technical specialists. And as I mentioned earlier, there's been a long legacy of underinvestment in process and technology in tax. It creates a very challenging environment. Move the clock forward a little bit and you have a whole host of new regulatory requirements that really bombard the tax function in succession. You've got FIN 48, 123R, the tax shelter regulations and the reportable transaction regulations, and on and on and on. And all the while, the resources headcount is stable or decreasing, and it creates an environment where tax is being asked to do more and more and more with a stable set of resources, which creates a very dangerous environment. So there's been a lot of stress on the tax department. Its challenges have been in terms of resources, recruiting, retaining qualified personnel, and really getting on the bandwagon in terms of managing technology for its benefit, and really getting on the same page with the overall finance function in terms of controls and processes. The best example that we have come across has to do with, I'll give you a hypothetical, a US-based multinational doing business in, say, 30, 40 foreign jurisdictions. In each one of those jurisdictions, they're required to prepare corporate income tax returns. And given, the in-country technical rules are different in each one of those filing jurisdictions, and the language barriers, most multinationals will outsource that work to a whole variety of third-party firms, accounting firms, law firms. And what many companies are now looking at is getting more leverage out of existing finance area shared service centers and moving tax processes into those existing shared service centers. And the impact that has is to reduce the spend or the cost with those third-party firms by taking some of the process to prepare those foreign in-country tax returns and moving them to the shared service center. And that won't entirely reduce your need for the third parties. Certainly there's technical issues that need to be addressed, but data collection, data management, data manipulation can very effectively be migrated to a shared service center, and you can get some good economies and efficiencies through the shared service center and take your spend with the third-party firms down by, we've seen 20-25% being realistic.